Welcome to the Capital News. I am your host, Alex Karitis. Today is Thursday, March 18th, 2021. Thank you so much for joining me. The title of today's podcast, Market Losses and Job Losses. This is on the back of yesterday's podcast where the Fed gave the market a pot of gold, at least temporary. As we stated in our write-up following the podcast, or to that yesterday's podcast, the knee-jerk reaction in response to the Federal Reserve's decision, and furthermore, the statements made by Jay Powell, the chairman of the Federal Reserve, allowed markets to rally in yesterday's afternoon trading session to close up in the green. But we said that might just be the knee-jerk reaction. One day does not make a trend, and we have to watch the follow-through. Well, today begins a little bit more of that follow-through, when markets have time to sort of digest that information a little bit more, see what it means, read between the lines, see what they can come up with, and apparently they didn't like it. Apparently, when they had time to digest what the Federal Reserve Chairman had to say in his statements and in his Q&A session with journalists and reporters, they must not have liked it because the major averages, the major indexes across the board on Wall Street were down today. Now, again, maybe that's nothing significant, but I think it might be, because we understand that these markets are completely addicted to this easy money, which they have been since the great financial crisis, which has been just building this massive bubble for the past 12 years, almost 13 years now, as we make our way through 2021. So this is just akin to drug addicts needing a bigger fix to get that same level of high that they're so used to. So markets might be calling out the Fed and other central bankers, saying the rhetoric, the narrative, the story is no longer enough. You have to show us your cards. It's put up or shut up time. This is a drug deal at this juncture. You can't just say that you have the merchandise. You have to show it to me right now. Otherwise, there's no deal. And what that means in this context is markets are going to go down until the Fed shows up with the merchandise. And even then, is it going to be enough? That's the ultimate question that we are contemplating. That is the ultimate question that we have been throwing out into the audience for the past several weeks, because to me, that's the only question that ultimately matters. Will the markets continue to buy the line that central banks are going to be there to save them? And will markets continue to increase so long as central banks continue to flood the markets with more liquidity? Now, federal governments, with their various forms of fiscal policy and whatever they attempt to do, that's the sideshow. It's important, yes, and we cover it and we talk about it here, but that all has to be financed by somebody. And it's being financed by central banks because nobody else wants to buy this junk, because all of this global sovereign debt, whether that's Japanese bonds, whether that's European bonds, whether that's U.S. bonds, it's all junk. And the only major buyers going into the market to buy these bonds across the curve are their respective central banks, because it's all junk. This is all a sideshow. It's all smoke and mirrors. It's one massive circus. It's a joke. We have the Bank of Japan leaving its key short-term interest rate unchanged this afternoon at a negative 0.1% and maintain the target for the 10-year Japanese government bond yield at around 0. Wow, you're really making a boatload of money there during its March meeting. This was in expectations. This met market expectations. Meantime, the central bank decided to widen the band at which it allows long-term interest rates to move around its 0% target and pledged to buy ETFs only when necessary instead of at a set annual pace. So isn't it interesting how they wrote up this article where the central bank, the Bank of Japan, will allow long-term interest rates to move around its 0% target. Is that what central banks are here for? To centrally plan the economy, to dictate to markets where yields and prices of assets are supposed to be set? Is that really their job? Oh, you're allowing us to do this. You're allowing markets to find fair market value. You're allowing markets to trend up and down a little bit. It's ridiculous. It's absurd. And then they're only going to buy ETFs, exchange-traded funds, only when necessary. Well, what do you think that means, only when necessary? When Japanese stocks go back to hitting all-time highs, then they'll continue to buy more? Or when they sell off? These people are just making this stuff up as they go. There's no economics behind this. This is all a con job. It's all about the narrative. Can they inject confidence into the system for the markets to continue to buy it? Because that's what most likely that means from the Bank of Japan. They're only going to purchase ETFs when necessary. To me, that means when stocks in Japan should sell off. Now, maybe I'm wrong, but we'll see. And that question will also be the same. Will the markets buy it? Okay, the Bank of Japan wants to come in. They want to print a whole bunch of yen, go to the Japanese stock market and buy a whole bunch of ETFs. Fantastic. But is it going to be enough to counteract selling pressure that's putting price pressure on those equities, putting them into the red? That's the question. Because once we start to see that, once we start to see central banks continue to flood their respective markets with liquidity, or with the Bank of Japan actually going into the stock market to buy ETFs, but you continue to see equities continue to trend and trade lower, then that's game over. Because there's no more faith and confidence in central banks. It's just going to be it. And what else do we have to pay attention to? Obviously the yield. So when we have market performance, right now we have the dollar index trading at 91.85. 91.85 on the dollar index. A little bit of strength today in the afternoon day session. Overnight, not a lot of market volatility in the Forex markets. However, with respect to cross-currency pairs with the U.S. dollar, some of those bigger pairs weakened quite considerably today during the dollar. So we'll continue to monitor that. Bitcoin at $57,800 a coin. Overnight futures trading, we have the Dow Jones and S&P 500 both down about 0.33%. The Nasdaq 100 is giving back about 0.5%. Speaking of Japan, the Japanese cash trade giving back 1.5%, a loss of 528 points. Clearly, they didn't like that the BOJ might be stepping back from purchasing ETFs. Again, this is their knee-jerk reaction, so we'll continue to watch what that follow-through turns into later this week, obviously tomorrow, Friday, and then next week. Pretty much a sea of green across the pond today in Europe. However, the Italian markets gave back 1.4% as they continue with their lockdowns. And don't forget, it's a central bank's world. Mario Draghi, the former president of the European Central Bank, is now the prime minister of Italy. And one of his first major decisions now is to, once again, put part of the country back into lockdown. Ain't it great? Ain't it great to be ruled by a bunch of central bankers? Australian cash trade giving back about 0.6%, and Chinese stocks also in the red, giving back 1.7%. On the share price front here in the U.S., Apple gave back 3.33%, Tesla gave back 6.9%, trading at $653 per share. Microsoft giving back 2.23%, Amazon giving back 3.5%, Facebook down 1.9%. Let's see here. Intel, another tech company, giving back 3.1%. And ExxonMobil giving back 4.3%. And the reason I mention that is because commodities got slammed today. WTI at $59.35, down several percentage points, same as Brent, now trading at $62.56. And natural gas is at $2.49. Now, one of the reasons why oil was taking a hit is because now some of the headlines today is, well, maybe COVID is starting to pick up again. Italy is shutting down. Parts of France, once again, are shutting down. What's going on here? I thought the narrative before this was everything was opening up and getting better. That's why markets were, again, rallying to all-time highs or near all-time highs. Did we not just have Jay Powell out yesterday saying that U.S. GDP is going to look better than what we anticipated? That growth is here, but we're just going to maintain our level of support and do whatever is necessary should the economy slip. So what's going on here? Now, we know where these energy prices really should be. If this was just based off of demand, yeah, they should be lower because the global economy, as far as I'm concerned, remains weak, as does the U.S. economy. Yeah, you can have trillion-dollar deficits. We can show you a good time for a little bit. But it's not structural. It's not here to last for a long time, and it's not going to, and it's going to cause a lot of problems. So from a demand side, yeah, not good. Prices should be lower. But from a supply side and from an inflationary standpoint, with what all these central banks are doing, yeah, the prices should be up. Now, nothing goes straight up, nothing goes straight down. But I imagine over this period, prices will once again turn around and go back up. Because the other thing that I think we are staring at in the face is a lot of geopolitical risk. And we're going to talk a little bit more about Lebanon here at the end of the podcast. I'm just going to read part of an article just to keep us updated, because obviously things are moving. It's a very fluid situation with this economic collapse and societal and political collapse over in Lebanon. So I just want to continue to be reminding the audience as to what can happen. Okay, it's the weakest links that go first. But to think that this can't happen in a more developed country, well, think again, because we're likely going to see it. So I think those geopolitical risks with other supply risks other supply pressures that we're dealing with now, and the inflationary effects are going to continue to put upward pressure on these prices net. Okay? Gold and silver. Gold is at $1,738 an ounce. Silver, $26.06 an ounce. And copper is at $4.03 per pound. And to round it out, Uncle Sam's 10-year junk note is at 1.69%. It was north of 1.7 earlier today, which of course takes us back to where we were last January. You could say pre-COVID, pre-pandemic, pre-restrictions, pre-lockdowns. And of course, it was an entirely different economy then. We didn't have several $1 trillion added to our national debt. We didn't have multi-trillion-dollar deficits. We did have a $1 trillion deficit, but weren't multi-trillions. Now they are back-to-back multi-trillion-dollar deficits. And the Democrats are just getting warmed up. The $1.9 trillion piece of crap, that piece of garbage, was just the opening act. That's the appetizer. Okay? Buckle up. They are just getting started. Unemployment was at nowhere near the levels it is today. And yet we have a 10-year back to where we were prior to all of this nonsense. So this is something that obviously continues to weigh on stocks, especially the tech sector, which, of course, we said yesterday there seemed to be a breakdown. But that's why I said one day does not make a trend. And it was just something to be mindful of, because the 10-year yield went up yesterday during and after Jay Powell's comments. Yet, markets rallied. Well, today we continue to get a rally in the 10-year yield, and we saw a sell-off in stocks, especially with the Nasdaq, the tech-heavy sector. So this is going to continue to be a thorn in the side of central banks, because, of course, they want to have it both ways. At least the Federal Reserve does. The Federal Reserve wants to say, yeah, they're going up, and that's perfectly fine because it's manageable, it's orderly, whatever this means, it's orderly. And, of course, this is signifying that we're growing. The economy's growing. Now, that's a bunch of hogwash. This is pricing in inflation as far as I'm concerned. And it'll get worse. Now, this isn't going to go straight up, and it's not going to go straight down either. But I think the trend is going to be maintained. I think it's going to continue to go higher. And we are going to be flirting with what I think are going to be some pretty dangerous levels. As I stated yesterday, as a reminder to the audience, the fourth quarter of 2018, when we had a federal funds rate of 2.4%, and Uncle Sam's 10-year junk note was a little over 3%. Well, again, the backdrop of how the economy looked in the fourth quarter of 2018 versus how it looks today, completely different story. We couldn't tolerate those levels of rates and yields in the fourth quarter of 2018. There's no way we're going to be able to maintain them now, which is why I think it's going to be even lower on the Fed funds rate and even lower on the 10-year yield to prick this bubble and to perhaps cause another sizable sell-off in equities. But again, this comes down to the story as to whether the markets want to continue to buy into central banks inject liquidity, we go higher. If it's that simple, then that's what's going to happen. They inject liquidity, markets go up. If the markets say enough's enough, then enough's enough, and I don't think there's going to be much of anything they can do. So it'd be buckle up time if and when that happens, and I really think it's just a question of when. And then don't forget, as I stated yesterday too, the Central Bank of Brazil increased their interest rates because they're dealing with the effects of inflation, and they don't like it. And quite frank, they didn't increase their interest rates enough to combat it, but they're going to continue to increase their interest rates in the months ahead because they have to combat inflation. This is not a good scenario at all. And another real quick thing before we get to the initial jobless claims report, let's go back real quick to commodity prices and how this can affect some of these emerging markets who happen to be large producers of oil, natural gas, what have you. Well, if you have higher prices, that can be some sort of alleviation for those countries because now they're bringing in more revenue, more tax revenue, more business, etc., etc. It can help to rebalance their economy, which of course many are struggling. If we continue to see downward pressure on these prices, well, then they're going to continue to suffer because they're not able to generate enough revenue. And even though they're still combating the effects of inflation, and in some countries it is quite devastating. As we mentioned earlier this week with Lebanon and Nigeria, Brazil is a case, Syria's got problems, Argentina, Venezuela, Turkey, go around the globe. Just getting started. But now on to the initial jobless claims report. So, for the week ending March 13th, initial jobless claims seasonally adjusted came in at 770,000. This is a week-over-week increase of 45,000. Last week's figures was revised upward, unfortunately, by 13,000 and now stands at 725,000. Initial jobless claims, non-seasonally adjusted, came in at 746,000, a week-over-week increase of some 24,000. Continuing jobless claims for the week ending March 6th, seasonally adjusted, come in at 4.1 million, a week-over-week decrease of 18,000. Non-seasonally adjusted continuing claims came in at around 4.5 million, a week-over-week decline of 95,000. For the week ending March 13th, for the Pandemic Unemployment Assistance Program, it now stands at 282,000. This is a week-over-week decline of some 196,000. Now, recall, this was the week when benefits were set to expire unless they passed the $1.9 trillion piece of garbage, which, of course, they did. This is very much akin to what we witnessed last December before they passed Nobody Cares Act 2.0, because Nobody Cares Act 1.0 was expiring at the end of last year, and so they wanted to extend things to the first quarter of this year. Well, we're already there. We're already there. And just like we witnessed at the end of last year, at the beginning of this year, no surprise, it was not a seamless transition. The government's in charge. What do you expect, people? It's going to be a bumpy ride. So there was some volatility with respect to those total numbers, and we're going to get to that here momentarily, because we've been seeing these swings of plus or minus 1 to 2 million when it takes the grand total, the aggregate of everybody claiming some form of unemployment insurance. So let's look at that right now, and this is going to be for the week ending February 27. Of course, this lags a couple of weeks. But we have regular state, federal employees, newly discharged veterans, the PUA, the PEUC programs, extended benefits, state additional benefits, and workshare gives us a grand total of 18.2 million. 18.2 million for aggregate numbers. That is a week-over-week decline of 1.9 million. So again, we see these large swings back and forth, plus or minus 1 million, plus or minus 2 million. Completely not stable. Something is amiss. And this whole jobs market has been amiss for the past year, which I had warned was going to be the case a year ago before all of these shenanigans began, because I said, look, the government is doing all this stuff because they want the unemployment numbers to look better than what they actually are. They don't want to, fuel the frenzy of chaos and economic disaster. So they want to make it seem like they have everything under control, or at least something under control. So let's pass the Nobody Cares Act. Let's give these businesses PPP loans. Of course, very little of that actually went out to small businesses to really affect anything, because if it did, we wouldn't be seeing these numbers like this on a week-by-week basis. 770,000 is still 100,000 higher than the depths of the great financial crisis. And that was only for a week or two that we saw 650, 660,000 during the depths of the GFC. We have been north of that. We have been at 700,000 plus going on 1 year. 1 full year of initial jobless claims. Worse than the depths of the GFC, which was the worst financial and economic crisis that we have seen since the Great Depression. So it should come as no surprise why I have been calling this the Greatest Depression. People just don't realize it yet. But when all of this fancy, funny money that is being distributed to everybody, because everybody thinks it's free, once that wears off, it's not going to be pretty. So it will be interesting to see when this $1.9 trillion bill expires, once it makes its way through the economy, once these stimulus checks are spent, these spending checks are spent, because it's not stimulative, what will Congress do then? Because that's only 6 months away. This will end in September. We're already near the end of the first quarter of 2021 already. That's how fast time is flying so far. Now, I don't want to look that far ahead, but we're going to be in September before we know it. And what are we going to have to show for it? Probably not much of anything. And the question will be, of course, what type of data is produced over this time period, especially with respect to inflation figures, which the Fed thinks is going to be under control. If it does rear its ugly head, it's going to be transitory. I don't know how they know this. They don't know anything. So how do they know it's going to be transitory? What are they citing that says it's going to be transitory? And, they've questioned the official unemployment rate at 6.2, 6.3%, and they say it's even higher, which I like to remind this audience that they have said that, and Jay Powell reiterated that yesterday. So if they're just going to pick and choose what data points they want and then say, yeah, that's the official number, but we don't believe it, well, what's stopping them from doing that with inflation? What happens if the CPI comes out and it gives us a reading of 3 or 4%? Is the Fed going to say, well, yeah, that's the official number, but we think it's 2%? I mean, don't be surprised. Whatever suits their purpose. Because with the official unemployment rate at 6.2%, the reason the Fed claiming that the quote-unquote real unemployment rate is closer to 10%, the reason that fits their narrative is because they wanted to advocate for more fiscal policy, for more fiscal spending, because that's how the Fed can justify going into the markets, buying up these bonds, and injecting the markets with U.S. dollars. Federal Reserve notes, a.k.a. funny money. That's why they were pushing for it. Now, they probably couldn't care less what's in it. They just wanted a big number. They just wanted 1.9 trillion. That's fantastic. We can finance that. That's all they wanted. It fits their narrative. So if we get a CPI reading over the course of the spring or summer that's at 3 or 4%, which is quite possible, and of course the number is that now, probably higher. But if it should officially come out as 3 or 4%, will the Fed dismiss it out of hand? Will they just say, well, that's what they say? But they also say, because it's the same departments, the Bureau of Labor Statistics, that calculates both of these numbers, well, yeah, that's what they say, but we think it's closer to 2%, and that's our goal. We want it to be around 2%, and we're content with that. So this 3 or 4% number that they're putting out there, it means absolutely nothing because we just don't believe it. Now, that'll be interesting. It's one thing to dismiss the unemployment rate. It'll be another if they continue to do this with others, especially inflation, because that's their dual mandate. Price stability, wrong, they failed there. And full employment, wrong again. But that's what they do. But again, 18.2 million Americans continue to claim some form of unemployment insurance for the week ending February 27. Now on to the Federal Reserve's balance sheet, hitting an all-time high at $7,693 billion. So almost $7.7 trillion, again an all-time high, a week-over-week change of over $100 billion. No surprise here. This number is likely going to hit north of $8.5 trillion by the end of the year, and I am projecting it very well could hit $10 trillion, especially if sleepy Joe Biden, Kamala and company, and the Democrats push a lot more down our throats. And of course, some of these things the Republicans may very well sign on to as well if it's something that can get some bipartisan support, and what that might be is something that pertains to infrastructure. Now, a lot of that money may not actually make its way through the system this year because there really are no shovel-ready jobs. You still have a lot of restrictions. You still have a lot of regulations and red tape at the federal, state, and local level. So I don't anticipate much success with anything, but of course it'll be sold as the best thing ever, just like it was, several years ago when Obama came into office and they had all of those shovel-ready projects and they were going to spend several $100 billion and we got nothing for it. So I anticipate something very similar, but that doesn't mean that the markets won't buy into it. It doesn't mean that the Federal Reserve won't be happy to finance it, because nobody else wants to finance this junk, because that's what it is. And of course, if we had taken the money that we have already spent over the past year and a half, we could have rebuilt our infrastructure coast to coast a couple times over. And don't forget, the ASCE, the American Society of Civil Engineers, has claimed that our infrastructure is at a C-. Now, that's the highest it's been since they've been reporting and grading our infrastructure. But a C- is not good enough for the United States of America, not when we are throwing trillions and trillions of dollars into the system. Just not going to cut it. We're supposed to be better than that. We're supposed to set the standard for the rest of the world to follow. We have been lagging for years. But there at the Federal Reserve, their balance sheet, again, nearing $7.7 trillion. And again, as I stated at the top of the podcast, M1 and M2 money stock will be calculated and updated now on a monthly basis as opposed to a week-by-week basis, since they have changed the definition of both of those monetary measures. Okay, but I will be sure to bring those to you when they are released. Now on to the article with respect to Lebanon. Again, not going to read the whole thing, just part of it, just to keep the audience updated. So this is strikes and closures. The currency has crashed so far in recent weeks, losing 1/3 of its value. That grocery shops closed on Wednesday, and bakeries cautioned they may have to follow suit. Many pharmacies shut their doors on Thursday and flashed neon strike signs, the latest sector of the economy to voice frustration. Ali Obeidid, a Beirut pharmacist, said he could no longer keep up with the expenses. Pharmacies will close permanently if this continues, he stated. Comments that subsidies, including on fuel, wheat, and medicine, may soon end have also triggered panic buying. Well, what a surprise. Banks have also imposed informal controls on people's savings, and the central bank's foreign reserves are dwindling in a country dependent on imports of more than 80% of its basic needs. Cars lined up outside gas stations earlier this week, and scenes of brawls over subsidized goods at supermarkets have heightened fears among Lebanese over their most basic of needs. The sharp descent of the pound sent protesters into the streets, blocking roads in anger at an entrenched political elite that has dominated Lebanon since the Civil War. But public anger has not spilled into nationwide protests similar to those in 2019, even as Lebanon is being gripped by multiple crises, including a surge in coronavirus infections and pressure on the health sector. So that's an update as to what's taking place in Lebanon. So protests aren't to the degree at which they were in 2019, but I imagine they will be in the not-too-distant future. I hope that's not the case, but I imagine it will be. And to be perfectly honest with you, a lot of these revolutions, these protests, they need to happen because there needs to be a massive political sea change. Of course, what gives me concern, especially with a lot of younger people who should be the ones taking over, especially at some point here, is that a lot of younger people buy into the notion that government is supposed to play a major role in everyday life. Now, of course, I am complete 180 of that, the complete opposite of that. I am for our constitutional republic here in the U.S. I am for free market capitalism. I am for as much liberty and freedom as possible for the individual. But a lot of young people don't believe that. Of course, there are some. But if they continue to buy into the notion that government is supposed to play a major role in our daily lives, then what's going to happen? It's going to be a case of meet the new boss, same as the old boss. Just younger, darker hair, not as many gray hairs. Well, that's not going to be a solution. So part of the solution is for some of these revolutions and protests to take place, to affect positive change. But we have to hope and pray that it is positive change and not the same thing under just a different face. That's what gives me the most concern. But if people can understand that we have to get rid of this government control, then our best days can be ahead of us. And that's something we can hope and pray for. But unfortunately, market losses and job losses continue to be the story of the day. We'll keep you updated as more data and information comes to the front. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.